as long as the AI story is here, this is actually bearish for gold. If real yields keep going higher, okay, it will burst the AI bubble. If the AI bubble burst, and my view is that it will happen this year, that's when gold is going to shine.
You know when the major gold bull market in it started. It started right after the dot-com bubble burst. That's when it
Sure,
started.
exactly. Exactly. There's no fiat currency out there that can take over the leadership from the US dollar. Therefore, it comes down to gold. You might have told me, oh, well, gold is a geopolitical risk proxy. That's bullshit. Because we know that during
I
the
just
war,
think it's
gold was
money,
going.
but you know. Hey guys, it's the Endgame Investor Rafi here, and I've got David Wu back on the channel. It's been a few years, but David is back, and he is the former head of global interest rates, foreign exchange, emerging markets, fixed income strategy, and economics research at Bank of America. And he's also a best-selling author. His book is out now, Merry-Go-Round Broke Down.
Merry-go-round broke down.
And anyone who is bullish gold should read that book. David, I wanted to talk to you about the interplay or the relationship between gold and AI. I have a few paragraphs I wanted to read to you, which challenges the AI thesis and hear your response to it. And you said that if you want to understand what gold is doing in its movement now, you should understand what is going on in AI. I agree that that is very important to understand, and I myself do not understand it, so I will defer to your expertise on this. Let me read those paragraphs to you, and we'll get your response to them. So these are written by McCann Research. He's actually my favorite gold and silver analyst, Daniel Oliver. And so he says this in September 2025, and then I'm going to move to a paper that he wrote more recently. Indeed, a study released last month, he says, finds that since the widespread adoption of generative AI, early career workers ages 20 to 25 in the most AI exposed occupations have experienced a 13% relative decline in employment even after controlling for firm level shocks. Dario Amodei, CEO of Anthropic, a developer of large language models, believes that AI could eliminate half of all entry level white collar jobs and lead to 10 to 20% overall unemployment over the next 5 years. The problem, he says, though, should be obvious to anyone active in the world, except for the geriatric. Customers only call when their problem cannot be easily addressed on the company's website, i.e., when they have a novel problem that AI by definition cannot solve. But the prospect of reducing employee headcount has enticed large companies to shove AI down their customers' throats. CVS, for example, has just deployed a new phone system that prevents the caller from reaching a human pharmacist no matter how many times he slams the zero button. Eventually, CVS's AI will offer the persistent voicemail option. Any AI cost savings will likely be matched by revenue loss, he says. The next paragraph I want to read from a different research paper written by the same author, and he says this. After consuming 767 billion of capital in 2026, the AI build out will absorb another $1 trillion in 2027 or just shy of 3% of GDP. The problem is that either AI turns out not to work as advertised, as we predicted in our last letter, making much of that debt impaired, or it does and throws millions of white collar employees out of work, a group that tends to have large mortgage balances and that drives consumer spending. Either the AI debt is going to have problems, or the mortgage credit card industry is. If the Fed lowers rates, as Kevin Warsh has promised, it would merely fund more AI, exacerbating this tension, not launch a new credit cycle. What do you say about that, David Wu?
I think there's a grain of truth in it, but obviously it doesn't explain why gold has done so poorly year to date, right? I mean, I don't tell you, gold has been the worst performing major asset in the world, other than Bitcoin, I would say year to date. This is, I mean, so from that point of view, and this is while the AI trade has been ripping higher. So from that point of view, regardless of what you might think about AI in the very long term, okay, I think the fact is that right now, as AI goes up, is definitely, gold has become its number one casualty. Now, but let me basically try to rephrase that because I think it's very important that we get into the sort of the brass tacks, understand the complex interplay between AI and gold, and what do I mean by that? First of all, I just want to say, if you ask me what's been the biggest prize of 2020, six so far, I would argue it's been this massive increase in real yields worldwide, but led by the US. Okay. If you look at, when we're talking when I say real yields, what I mean by, of course, I assume everybody knows, real yields basically refers to the yield that you earn, the after inflation yield that you earn on an inflation index bond. Okay. So currently, if you buy a 10-year US inflation index government bond, it is yielding 2.3%. Okay. And it is near actually the highest level in 5 years.
Are you talking
So
about specifically tips or generally interest
tips,
rates
we're talking
minus
about tips.
inflation level?
We're talking
Okay.
about tips. We're
Okay.
talking about tips in particular. But if you look at, like if you look at inflation index bonds elsewhere, even in Japan, in Germany, in France, they've all gone up this year. Okay. They've gone up especially, okay, since the joint US Israeli attack on Iran, okay, the last weekend of February. Since then, I mean, literally, like it's amazing, like real yields have really gone up. Now, the question is why? And then obviously, and I can tell you there's no doubt, gold has been devastated by this big increase in real yields for a pretty obvious reason, because gold is an inflation hedge, so is an inflation index bond, and gold doesn't pay you an interest. So when an inflation, you know, index asset sees basically a big increase in yield, that obviously is bearish for gold. So there's no doubt that, that gold has been weighed down by this repricing in real yields. The question is, therefore, why have real yields gone up so much?
Continue on that thought, but I just wanted to disagree on a little bit of a point that gold does pay interest if you loan it out, just as dollars only pay interest if you loan it out. So they would pay the same kind of interest if you loan them out. It doesn't make a difference. If you like awesome off-the-cuff segues and you want to earn interest on your gold and silver, then you can do so at Monetary Metals, monetary-metals/Rafi, and you can support this channel link in the description below. You can earn 4% on your gold that you deposit with Monetary Metals, and your gold will earn a yield about the same as investing, quote unquote, in a 10-year treasury bond, which you probably shouldn't do, especially if you're a gold bug. Anyway, back to David Wu talking about gold and AI.
Sure, yeah, that's true. You can let it out for people who want to go short it and whatever it is. But I'm just talking about in general when you have a piece of gold sitting in your bank account, or even you're sitting on a GLD, whatever ETF share, whatever it doesn't pay you any interest.
Monetary Metals does in gold terms. Monetary-metals.com/Rafi.
Okay, so that's what it is. Now, the point here is that therefore, I'm just saying that therefore, to understand gold has done poorly this year, and this has been mainly the result of higher real yields. And real yields have gone up mainly after basically Israel and the US attacked Iran at the end of February. Now, until a few weeks ago, if we were having this conversation, we would say, oh, wow, why have real yields gone up? You're going to say, well, it's because of high oil price, dummy, right? Because the idea was, well, after the war broke out, oil price went through the roof, and therefore real yields, was thought to have gone higher because it was going
Oh,
to,
but
that the
you're
Fed
saying
will
now
have
that that's proven wrong because oil's come down and the yields haven't.
Exactly, right? So
Okay.
basically, this thesis that real yields went up because monetary policy will have to get much tighter to contain the second round effect of the oil fallout, that has been disproved. Because oil, as you said, oil price has gone down and gold is actually lower even, okay? And mainly because real yields are actually higher. It's actually very interesting what's going on. So, so the question therefore is, why are real yields even higher?
Mhm.
After basically the oil price went down. That's the reason why, like, the correlation between gold and oil has actually flipped, right? You
Right.
know, and so the question is, why are real yields still up here? The reason is very simple. Is because the US economy, because real yields is just a function of three things. Okay. It's a function of growth expectations. It's a function of monetary policy outlook. It's a function of term premium, which is about like, long-term concern about fiscal sustainability, all that. I can tell you that term premium has gone down a lot in the last basically couple of months. So from that point of view, it's not term premium that's pushed up real yields. So therefore, it's about essentially growth expectation having improved. Now you might say, well, that cannot be the case because GDP growth forecast for this year has been revised down from 2.4% at the start of this year to now only 2.1%. Okay, so how can you explain higher real yields because of growth expectations? But I think the important thing is that since April, U.S. activity data, economic data, have been surprising to the upside very consistently. In fact, my own, data surprise index for the US, activity surprise, and it's exponentially weighted, is now at the highest level in 5 years. Okay. In fact, after the 2021 bounce, whatever, like we're now like at literally the highest. In other words, that the US economy has done since the beginning of April, that is April, May, and June, for 3 months, the US economy has done a lot better than anybody had imagined 3 months earlier. Okay?
Okay.
This is the reason why real yields have gone up. Okay. And now the question, of course, therefore, is why is the US? So therefore, I'm telling you, gold is done poorly because real yields have gone up. And the reason why real yields have gone up is because US data have been surprising to the upside. And my analysis shows.
Can I just ask a question? But that doesn't make sense to me because in the late 70s to early 80s, real yields were going way, way, way up and gold was going even higher.
Because actually real yields was not going way up because you're talking about there were no tips, by the way. Tips were only introduced in 1997, so there were no tips.
Just because it's an instrument based on an idea called real yield, that's inflation minus the rising consumer price costs.
No, because I'll tell you what,
yield
back
minus
in the 70s, the central banks did not try to fight inflation. Yeah, nominal yields were very high, but inflation was very high. As a result, real interest rates were actually quite low. And then inflation got out of control. That became a very different story. I'm just talking about right now. I'm just telling you that right now, I mean, there's plenty of evidence in the last 15, 20 years, whatever, ever since TIPS basically came into existence and so on, with the modern monetary policy framework, that essentially, generally speaking, my analysis shows that real yields tend to respond positively to positive data surprises. So growth, activity data surprise to the upside, real yields tend to go up, especially when inflation is above the Fed's 2% target. In other words, that when inflation is running above 2%, when data surprise to the upside, the Fed is under more pressure to respond more aggressively. And so what I'm saying is that the fact that right now inflation is above 2% and data being surprised into the upside is the reason why we've seen this massive repricing of real yields. This is also the reason why that the Fed, now is talking about at least one more rate hike between now and year end. So therefore, what I'm telling you is that gold has been a casualty of upside surprise in the U.S. data at a time that inflation has been uncomfortably high for the Fed. Now, therefore, the question is, okay, all that is well and good. The question is, if you think about gold in the second half of this year, like at the end of the day, it's about, okay, fine. So what's going to happen to real yields? Or rather, what's going to happen to U.S. growth momentum? Right.
Okay, so I guess
data continue to surprise to the upside, and that and so on and so forth. Now, in order to answer that question, we have to ask ourselves, because honestly, I didn't expect the U.S. economy to do as well as it did in the last 3 months, to be honest. So I have to, before I can even tell you, before I can even pretend to know like what I think is going to happen to real yields in the second half of the year, I got to understand like what exactly drove up the U.S. economy, in the last 3 months. This is something very, very important. Now, everybody will tell you, oh, well, it's because the consumers kept spending despite higher gasoline price because the so-called tax refund, right? Because last year we had the big, beautiful bill and there was tax refund because of these are tax cuts on overtime pay and on whatever, waitering, whatever it is.
Right. That sounds kind of weak.
Yeah. But in any event, a lot of people were thinking that this was going to come to about $100 billion.
$100 billion.
Which is not a small, basically pocket change. But actually, based on the latest IRS numbers, it looks like the grand total is probably no more than $50 billion, which is literally a drop in the ocean. So even though like Wall Street likes to believe that the economy surprised to the upside because you got this basically extra infusion of, basically money from the tax cut, I think that could not be the main story.
Okay, we agree on
I
that.
think the main story has been something very different, which is connected to AI. Okay. First of all, there's a there are these tax provisions in the big beautiful bill passed last year, which allows companies to write off 100% immediately, okay, any R&D expenses, any CapEx expenses, any expenses associated with building manufacturing structures. Now,
Okay, so that
this
incentivizes building the AI
part of
infrastructure
it,
without paying
no doubt
taxes on
about
it.
that. Now, what's
Okay.
interesting is that last year, I mean, you would have thought, because the big beautiful bill was already passed in July last year. You would have thought that, well, this should have had a big impact on the economy already last year, but it did. And the reason is because that we had this massive shock to policy uncertainty. We had the trade war, we had the government shutdown, we had a lot of uncertainty about monetary policy outlook and so on and so forth. I think this is the reason why many companies simply held off from hiring, from basically spending money on capex. And I think coming into this year, as policy uncertainty dropped and is now at the lowest level in more than a year, okay, companies, what you're seeing now has been the release of pent-up demand, okay, in capex and hiring. This is the reason. So it's not just about AI. AI is a very big part of it. AI is also about the fact that the AI trade, by driving up the stock market, has made Americans feel wealthier. So they went out and spent money
So
because,
it's the same wealth effect as .com or any bubble. I mean,
any of like,
yeah.
so basically it's a combination of several factors. You've got the wealth effect here, you've got the tax provisions here, you've got the fact that people really believe that AI is going to change the world. So whatever the reason is, it doesn't really matter. The point here is that as long as the AI story is here to stay, okay, this is actually bearish for gold. Now, of course, then the question is, so where does it take me? Like in terms of like, what do I think is going to happen to real yields and the second half of the year, right?
Mm-hmm.
If this is a story. I would say the way I think about this is that because we're talking about like reduced policy uncertainty, tax provision, AI, and so on and so forth, all else being equal, I can definitely see real yields going higher still from here. Especially, I can even see inflation starting to surprise to the upside, which will put even more pressure on the Fed to sound more hawkish on real yields in general. But I think that real yields, my personal view is that if real yields keep going higher, okay, it will burst the AI bubble. Because I have no doubt AI is a bubble by now for lots of different reasons, and we can talk about this because there is a geopolitical dimension, there's an economic dimension, there's a political dimension. I think that Anthropic and OpenAI right now are both struggling. The only reason why the market doesn't know or cannot know is because these are privately held companies, so they are not obligated to release their financials. But let me tell you, we can talk about this a little bit later. But my view is that if right now higher real yields has been a problem for gold, but as real yields keep going higher, this is going to be a problem for everything.
Yeah, yeah.
In
Look,
fact, if you
I
look at the
completely agree
sense
with you on that. I definitely. But okay, let me just ask this question and continue on your line of thought. Haven't real yields been going up since 2021? They were going up from 2021 to 2025, and gold was going way up too. And now all of a sudden you're saying real yields are bringing gold down?
no, real yields actually went down last year, by the way. I mean, so the best
I
year
mean, but
that gold has
they
had.
were much higher. But they're still much over the past since the lockdown, since the
Yeah,
COVID
since the
lockdowns, right?
lockdown,
They've
obviously real yields have recovered, but there are a lot of different reasons here at any given point in time. I'm just saying that one of the reasons why real yields did one of the reasons why gold did very well last year was because real yields went down because of mounting expectation the Fed's next move was going to be a cut. that we were coming to the end of the cycle and that the economy was set to slow and so on and so forth. I'm just saying that the fact that it didn't turn out, and there are other reasons, of course, there's also the geopolitical angle, like
Oh, okay,
US
okay.
and China.
Okay,
I
so
mean,
those are our
but these are different
disagreements that
stories.
we've
But
talked
I'm
about
just talking
before,
about
but
right now, at this moment in time. I'm just telling you,
yeah,
at this moment in time, the biggest driver of gold, because at any given point in time, there's something else driving gold. We know.
right.
Like, for example, you might have told me, oh, well, gold is a geopolitical risk proxy. That's bullshit. Because we know that during
I
the
just
war,
think it's
gold was
money,
going,
but you know,
yeah,
whatever.
gold was collapsing in the middle of the war. I mean, so that's bullshit, right? People tell you, like gold bugs will tell you stories about like why you should buy gold. The truth is that these things, like they're just stories at the end of the day. But what I'm saying to you is that but right now, there's no doubt in my mind, because you can see very clearly the gold real yield correlation is very, very negative right now. Okay. And this is what's been going on. But my point here is this. Until now, rising real yields has been bad news for gold. But if real yields keep going higher, this is going to be bad for everything, including for AI. Okay. And
Okay.
then and then actually, by the way, this is what actually happened in the run up to .com, which is that, before the .com bubble burst, real yields were going. And then eventually that burst the bubble because, at a certain point, if you could basically earn whatever 2.5%, 3% on on an inflation index bond, it was like, well, what the hell? That sounds pretty attractive. Everybody's going to go for that. So I think what happens, in my view, is that if the AI bubble burst, okay, and my view is that it will happen this year. I cannot tell you exactly when, but my view is that it's coming. Okay. And we can talk about why that's the case. But once the AI bubble burst, that's when gold is going to shine. I mean,
Okay, yeah.
then,
Look, I
you know,
completely agree with you. You know what? What's interesting, I just had this thought, but it should be it should be obvious. You know when the major gold bull market it started. It started right after the dot-com bubble burst. That's when it
sure,
started.
exactly, exactly, exactly.
Right. Okay.
So I
So
think,
you're saying I think you and I agree on this point that the what I'll use different terminology than you will. I would say that when a credit bubble is inflating, gold goes down. But when the credit bubble bursts, then gold initially drops, but then rises again once they try to reinflate the credit bubble. That's how I term it. But I think we're talking about the same things in different words.
but AI is not a credit bubble. I mean, this is not like the
It's
2008,
fueled by a credit bubble.
that was what? I
I
mean,
think
I
it's
don't think AI
fueled
is,
by a credit bubble.
well, I'm sorry.
I think it's fueled by a credit bubble. AI itself isn't a credit bubble, but all this debt that they're using to try to build out data centers and all this, it's fueled by credit.
I don't know if it's credit. I mean, this year obviously they spend more on, raising more bonds, but the equity issuance has been the big story, right? I mean, I would say it's an equity bubble. I mean, in the sense that, that these companies like, I was just thinking about this, like SpaceX IPO, like as some over $1 trillion immediately that gave a war chest, to basically pay for Cursor, another AI company for $60 billion on the first day. I mean, that's what we're talking about here. So, but it doesn't really matter. It doesn't really matter. But the point here is that what kind of bubble it is. But you're right. I mean, I think what happened was that also leading into the .com bubble, the dollar did very well.
Yeah.
Okay. Because at the time, just like today, at the time, the .com bubble, nobody thought it was a bubble until it had burst. But the point here is that it was thought that the whole PC revolution, the whole basically thing was an American revolution that was going to make America rich. That's why the dollar was so strong. If you want to basically invest in these companies, Cisco, whatever, Microsoft, you have to buy dollar in order to buy these stocks. The
Right.
same thing now that the AI bubble is seen as being an American thing. And therefore, you got to basically buy dollar in order to basically buy NVIDIA, whatever, or SpaceX or anything else for that matter. So therefore, when the AI bubble burst, that will be also the end of, that will also basically be a turning point for the dollar. I mean, obviously, when that bursts, that's going to have a disproportionately larger negative impact on the U.S. economy than
What
other
what do
economies.
you think is going to
So
happen to
that,
the dollar after the AI bubble bursts?
no, I think the dollar is going to be a shit show. I think in that case, I mean, not that I'm bullish any other currency, but
Yeah.
but I think the dollar will be a shit show. There's no doubt about that. Okay.
Okay. Well, the definition of the dollar being a shit show is gold going up, in my thinking. I don't know if you agree with that, but uh,
I think that's absolutely true. I think, I think today, like, I think, it's very clear, right? I mean, it's like the Chinese economy, right? I mean, if you look at the RMB is actually weakened lately. The Chinese stock market has done really badly this year. I mean, despite the fact that, like China is like supposedly the biggest winner of, the war in Iran and so on and so forth. But the Chinese stock market is not doing well because the Chinese economy is not doing well. Europe is literally like doing very, very badly. You probably just heard that, Volkswagen just announced that they're considering, laying off 100,000 workers. So I think so from that point of view, and the Japanese yen just hit a 60-year low against the US dollar.
yeah.
So all else being equal, there's no fiat currency out there that can take over the leadership from the US dollar. Therefore, it comes down to gold. Now, of course, there's another wrinkle in gold, which is very important. And let's not
Hmm.
forget that, which is the fact that I have no doubt another reason why gold's done poorly this year is because I think many of the oil producing countries in the Gulf have been selling gold because these countries have gotten screwed big time by the war, right? I mean, because these guys were big gold buyer, like the Saudis, UAE. I'm telling you, like right now, Abu Dhabi has become Dubai has become the new center for gold trading in the world. Like these Arabs, they just love gold.
Uh-huh.
But guess what? These countries are all now in serious, serious financial straits. They couldn't export oil. So therefore, as a result, they are in deep financial straits. Now, even though the war is over, okay, oil prices have come down a lot, and then the future does not bode well for
Oh,
oil
so you're
price.
saying they can't make up for the loss because oil prices are down?
Not just that. These countries have been selling their gold. Because just think about this. I mean, they're like, they're sitting there like, wow, what are we going to do? Like, we're running now big budget deficit. Okay. We need to basically make up for all of this. Just think about this. I mean, the Saudis, I mean, so they need to basically rebuild the country. That will require hundreds of billions of dollars that they haven't got. They will have to basically increase defense spending, which will involve hundreds of billions of dollars they haven't got. Oil revenue most likely will be lower because like UAE just basically left, basically OPEC, Iraq is now threatening to leave. Like the whole OPEC is coming undone. If oil prices really go down, that will take away the biggest buyer of gold, and that will
Blank?
go up in the ass. Unfortunately, I'm sorry my language, but that's a problem. That's another major problem. Let's not forget this.
You're saying, hold on, let me just understand it. So you're saying if oil prices go low enough, it would force the Arabs to sell even more gold and it would be very negative for gold.
I think that will be the case, actually. Because in a way, the problem now is that in the last 3 months, it's like, well, even though oil price was high, they were not selling any oil.
Hmm.
That's the reason why, let me put it this way. If they had to sell their reserves to fund their spending today, it's not exactly that they can basically sell, well, let's go sell some US government bonds. Because all the US government bond holdings are held with the Federal Reserve Bank of New York.
Right.
As soon as they give the order to sell some US government bonds, they would have gotten a
Blank?
phone call from Trump saying, what the
You're not looking at the big picture.
do you think you're doing? Okay. So they can't sell US government bonds. So the only thing they can sell is gold. And I
Okay.
think that's what actually happened. So this is why, that's a reality. So from that point of view, that's something we should just basically bear in mind. I do think that, I do think that long term, I think gold will do very well, especially if after the AI bubble has burst. I think we're going to, the world economy is going to a shit show. But I don't think, but there's no doubt there's been a lot of gold selling, okay, from the Middle East. And so in a way, you need those selling flows to play out. Now, of course, you also have got India, right? I mean, India, you know, I mean, has always been a major importer of gold for jewelry demand. And then look at what the rupee is trading at. It's been the worst performing currency year to date. And then, which means that India's purchasing power in rupee terms for gold has gone down a lot.
Yeah.
And that is being reflected also in lower gold price because at the end of the day, jewelry demand is about 25% of overall gold demand. So you got to factor that in. So what I'm saying is that what happened in 2025, where gold went up 60%, whatever. I mean, to me, that was, that was due to a very rare combination of things. And you don't think you're going to get that. But at this point, to get back into gold, you need to see the AI bubble burst first.
Okay. I think I agree with that point at least. I have one more question. You said that there's no currency that can take over the dollar. I agree with you, but on a sort of a sidestep question, what is the deal with the shekel? Why is it so strong? Do you know
Oh,
what's
the shekel is
happening?
very strong for, I think, I mean, it just tells you that the Israeli economy is incredible. Now, I want to take that back for a second, just to basically, I mean, one reason is because Israel, 15% of total employment in Israel, okay, is in tech. Okay. Like this is like higher than any country you can name. Like I think this the second highest 3 or 4% of the workforce. Israel, you're talking about 12 to 15%. It's like literally like this economy is more geared to technology than any other economies in the world, like bar none. Okay. So from that point of view, given that we are living through this huge, technology boom, what we call AI, you can call it whatever it is, this has been very bullish for Israel. I mean, in terms of, capital coming into Israel, into venture capital, startups, and so on and so forth, and Israeli companies' ability to sell, basically, startups to foreign companies for a lot of money. That has been a major. So in that sense, shekel, unlike gold, has been the opposite side. Shekel has been a beneficiary of the whole AI trade. That's the number one thing we should know.
Okay.
The second reason is because anti-Semitism. Anti-Semitism is on a sharp rise globally. I think it's completely disgusting. I'm not even Jewish. I live in Israel. I think the treatment of Jews in America and in Europe is totally despicable. But what is also true is that they're driving away the Jews, and the Jews are coming to Israel. I cannot tell you, I'm a professor of economics
To,
at
to me,
Rice.
this is all divinely planned, but that's a different subject.
That's a different subject. But I'm a professor of economics at Reichman University here in Israel. I've been teaching, in the MA program for financial economics for much of the last 9 years. And then, about 50% of my students are Israelis. The other 50% are usually, Jews abroad who decided to make aliyah to Israel and use this program as a springboard to joining Israeli society. And what I can tell you is this, I used to complain about the quality of my students, saying like I've always said, like, all these students, these are like kids that can't get into Harvard. They end up coming to Reichman to do their undergraduate studies.
Poor boobies.
Now, I'm telling you, in the last year, my kids probably could have gone into Harvard and Yale. They decided not to go and come to Israel instead because they are
They'd be
worried
afraid.
for
They'd be
their
afraid.
lives. They'll be
Yeah.
afraid. And I think that's the reality. The reality is that the world is driving away its Jews. And when Israel becomes the only place they can go, I mean, this is where money goes.
Well, that
And
was the
that's what it
point. That
is.
was the point of the founding of the state. That's the entire reason for its existence, because we knew this would happen again, and we need some place to go when it does.
Exactly. So, and those who don't come to Israel, they are enemies of the states. I mean, my view, like, that scumbag, basically Kushner and Witkoff, the two Jews who negotiated the MOU with that anti-Semite JD Vance, they're
Yeah, yeah.
disgusting. They're disgusting Jews.
I call
But
him. I call him
but then again,
Chaim David Vance. Chaim David.
but
James
anyway,
David.
as we know that the worst enemies of Israel have been Jews in the past.
Oh yeah.
And that movie just keeps playing and playing and playing. But meanwhile, again, Israel's getting stronger. Israeli defense technology. I mean, Israel, like the amount of, I mean, the strength between the growing ties between Israel and India, it's just like incredible. So I mean, again, it's a very little country, 10 million people. It can just eat the crumb on the table and it's going to get fat. And that's
Yeah.
what's going on. So that this is what people don't realize is that this country, you know, this country is going to survive. And then, in fact, anti-Semitism is actually making this country stronger, even.
Yeah. Well, that's actually a fascinating point. I didn't think of that, but it makes a lot of sense. Look, I really appreciate this conversation, and it opened up a lot of topics to me that I haven't, a lot of ways of thinking that I haven't considered. Basically, I think your basic point about gold, I agree with. For the major rally to continue, we're going to have to see the AI bubble burst, and when that does, in my view, it's going to be the end game. But we can disagree about that, and we'll see. We'll hook up again once the AI bubble bursts, and we'll see if the internet's still up, or if people are eating each other in the streets, and if Israel's okay.
Yes. Exactly. Okay,
Okay.
that's great. Great talking to you, Rafi.
You too. Thanks for coming on.